It's still not enough. These mortgage rates have come down, and we've all been very hopeful that this is going to spur some more buyer activity, and it's not. So, what's going on? Let's talk about it. Big drop in mortgage rates fuels refis, but home buyers unmoved. So, what we're seeing is actually the refi market is starting to pick up, but purchase applications are not. They're saying that the MBA weekly application survey showed requests for purchase loans fell by a seasonally adjusted 3% last week compared to the week before, and were down 14% from a year ago. Requests to refinance soared 15% week over week and were up 37% from a year ago, the highest level since August of 2022. So, this is saying that mortgage rates have moved enough for people who got in at a higher rate to consider refinancing because they plan to stay in their home. And people who are still on the sidelines are like, yeah, no, it's just really not low enough for me yet. So, what is happening here? We've talked a lot about affordability on my channel. We've talked about where prices are at, where mortgage rates are at. Every week, we're tracking mortgage rates. But really, at the end of the day, affordability is strained, especially in the Phoenix metro market. So, typical housing payment drops to $115 below record high as mortgage rates decline. So, you would think this would be really good news. But house hunters are still waiting on the sidelines. This article is from Redfin. They are looking at a national scale here, but they're talking about how a home buyer on a $3,000 monthly budget can afford $450,000, a home worth $450,000, with a 6.8% mortgage rate. And that buyer has gained about $25,000 in purchasing power since rates hit a 5-month peak in April. So basically, if we look back to where rates were at in April, if you wanted to keep your payment at $3,000 a month, you would have had to buy a house worth $425,000 versus $450,000. So the change in rates has created some opportunity for affordability for many people, but it's still not enough. Like, what is enough for home buyers? That's the question. I think many people are going to say prices also need to come down. But at this point, you can get more for your money today than you could have in April, when we're just looking only at where mortgage rates are at. To look at affordability another way, the typical U.S. home buyer's monthly housing payment was $2,722 during the 4 weeks ending July 14th, which is $115 lower than April's all-time high. That's despite home prices sitting just about $100 shy of last week's record high. So this article goes on to talk about how rising supply is another great factor for home buyers, but buyers have yet to react strongly to the falling rates and the increasing inventory. We have pending home sales that are down 5.6% year over year, which is the biggest decline in 8 months. A lot of this stuff we've talked about on my channel, but it persists even though we've been seeing these changes in mortgage rates. Now, this article is just an additional data point on why buyers are probably stuck on the sidelines. Typical Metro Phoenix home buyers need $186,000 down payment, according to Zillow. And here's how they break this down. They're saying that a Metro Phoenix household earning the median income needs a 40% down payment to afford a home purchase. And they're considering that you want your monthly mortgage cost to be no more than 30% of the household's income. So what they did is they looked at what the median household income for Phoenix was, which is about $91,300. Home buyers earning that median income have to put down $186,000 in order to keep their monthly payment at no more than 30% of their monthly income. And that would be on that median priced home of $461,000. Now, we can look at this in a number of ways. There is some argument to be made about household income, the median versus the average, and when we get the most recent updated information about household income. So I would say this is definitely not set in stone. However, yes, if you're trying to keep your mortgage rate down with the way rates are, or I'm sorry, if you're trying to keep your mortgage payment down at the level rates are at today, then yes, you are putting a pretty large down payment down on that median home in order to keep that ratio where you want it to be. Now, they go on to talk about a few options that they have. One thing being down payment assistance. Phoenix Metro homebuyers receive an average of $21,000 in down payment assistance. Some other hacks that they mentioned is that you can do an assumable loan. So I've talked about this, I think last week or the previous week. Finding a home with an assumable loan is also an option. You do have to make it your primary residence, but it is something that could work really well if you have a larger down payment for the most part. You do need some cash to come to the table with, but you can assume a loan at a lower interest rate. If you want some assumable loan options, check the description below. I have a link for that. They also talk about rate buy downs. So mortgage rate buy downs are another popular thing, which is basically sellers giving you funds in the form of a seller concession to buy down your interest rate, thereby making your monthly mortgage payment more affordable. So rate buy downs, whether it's just buying down a point or if it's a format like a 2-1 buy down, those are some other options. And finally, what they don't mention in here, but something that I've also talked about on my channel, is doing a seller financing transactions, meaning that your down payment will need to pay off the seller's loan amount if they do have a loan on the property still. And the remaining balance is something that you finance through the seller. And that is all negotiable. So that can be at a lower interest rate. It could be an interest-only payment. There are different ways to negotiate that with the sellers, but anything related to seller financing can also help you keep that mortgage payment in a realm where you're comfortable. Again, you may need a larger down payment for this, but it really depends on the situation. So if you want a list of homes that you could buy with seller financing, check the description. I have a link for that there as well. So knowing that mortgage rates have been coming down, but we're not seeing the uptick in buyer activity, is the market in trouble? I don't think so. We've talked about this many times. I think we're just at a slower point right now. And it's not a bad thing that prices start to level off a little bit and activity is a little bit lower. We kind of reset from the crazy years that we've had in the past. But there is one indicator that can show us a red flag when it gets below a certain number. And I want to talk more about that in a minute. So we're going to get there. I first want to talk about what's happening in the economy this week. We are going to get the PCE on Friday. This is the personal consumption expenditure. This is the Fed's preferred gauge of inflation. It is expected that the core PCE increases 2.5% in June from the previous year, down from May's 2.6% annual gain. Over the prior month, economists expect core PCE rose 0.2%, slightly above May's 0.1% increase. So we'll find out about this on Friday. And then next week, the Fed actually meets for their policy decision on July 31st. So more news to come there. Assuming that the PCE and all of this data comes out as expected, we probably won't see a big move in mortgage rates. But if it comes out higher or lower, we may see some changes with mortgage rates. It is widely expected that the Fed is going to keep rates the same at this meeting. So doesn't seem like much excitement there, although they are still talking about a rate cut in September. Now, keep in mind, when we're talking about the federal funds rate and the Fed cutting that rate, that does not mean mortgage rates will go down. Mortgage rates actually move in anticipation of these types of things. So if you are waiting until September to see if the Fed cuts the rate and then hoping that that will impact mortgage rates, you're actually waiting too long. With all of the discussion right now of the Fed potentially cutting the rate and the certainty, mortgage rates are reacting to that now. And that's why we've been seeing a lot of the decline in rates lately. So where are rates today? We went up just a little bit on Friday, ended the week at 6.89%. Before that, on Thursday, we were at 6.81%. So a very slight increase. But overall, we're lower than we were at this peak, which was July 1st. Before that, the peak that we saw was at the end of May, on May 29th. And before that, in the spring, this is when we got up fairly high at 7.51%. So that was the end of April. So if you compare 7.51% in April to where we stand today at 6.81% or 6.89%, we've made a pretty significant move in mortgage rates since we peaked. And then just for curiosity's sake, going back to the beginning of the year in January here, we were at 6.7. So we're just a little bit higher than where we started the year. And if you remember, there were a lot of buyers out in the beginning of the year. January, February, March were pretty busy before we started to see rates creeping up again. So let's talk about that red flag indicator. And this is from the Cromford Report. I love the data that they provide. I'm a subscriber and they have the best stuff. Honestly, they help me keep track of what's going on with the market. By the way, if any of this is helpful for you, consider subscribing. I'm here every single Tuesday giving an update on what's going on in the Phoenix market. So the sales price to list price ratio is what the Cromford Report says is another great thing to track to help us understand the market conditions and where the market might be heading. Now, they do say this is a little bit of a lagging indicator. It's not quite as timely as the Cromford Market Index or the contract ratio, which I will also share here in a minute. But this is really comparing what the sales price is of a property as compared to what it was listed for before it went under contract. So 97.5% is where we stand today with the list price to sales price ratio, meaning that sellers are getting about 97.5% of their list price. Now, the long-term average for this sales price to list price ratio is 97.38%. That's from the years 2001 to 2024. And that suggests that the market is slightly stronger now compared to average since we're at 97.5, just slightly stronger. But last month, if you see where we're at about 97.8, 97.9. So this is showing that we are in kind of a short-term falling trend with the sales price to list price ratio, meaning that's what we're experiencing in the market, a little bit of a falling trend. And all of that aligns with what we've been seeing in the CMI and the contract ratio. Now, a year ago, we were at 98.3%. So obviously a stronger market last year than where we're at today. Now, like I said, the long-term average is about 97.38%. And the Cromford Report says that a reading below 97% is actually a red flag. They saw this happen September of 2006, much later than some other signals, but it was well before prices began to fall dramatically. Now, in recent times, we saw this fall below 97% in December of 2022. This is where we hit 96.6%. Now we were there under 97% for a short period of time. It quickly recovered to 97% by February and has stayed above 97% ever since. So right now we're on this downward trend, 97.5%. I don't know how much lower this will go, but if we do see this dip below 97%, along with the other indicators that we'll likely be seeing and tracking at the same time, we know that the market is going in a direction where prices will begin to fall and things are weakening even further. So let's take a look at the Cromford Market Index this week. We're at 100.6, so we are in a balanced market, really minimal change week over week that we've been seeing lately. Demand is at 74.9, so about 25% below normal. Supply is at 74.4, and again, just about 25% below normal, which means we are in this balanced market at 100.6. The average change month over month in the last week was negative 6.7%. And last week, that number was negative 7.2%. So what does that mean? We had a smaller shift month over month. The rate of decline of the CMI slowed down a little bit from last week to this week when we compare month over month. So that means that maybe we're going to hang here at 100 for a little bit longer before we dip into the 90s. It just seems that things are slowing down a little bit. So we'll see. Now, every city behaves a little bit differently. We have some cities that are still in a pretty strong seller's market, other cities that are in a pretty solid buyer's market. Buckeye being a buyer's market, Maricopa, Queen Creek, Cave Creek, Goodyear, and Surprise Paradise Valley and Peoria are both in balanced markets. And then Tempe to Chandler is all in a seller's market. Now, there are only a few cities in seller's markets that are pretty strong seller markets. So like Fountain Hills, Avondale, and Chandler all are above 140. So they're fairly strong. But Chandler and Fountain Hills are dropping fairly significantly, down 13% and 10% from the last month. So those could be leaving that seller's market sooner than later. Hard to know if they keep declining that quickly. We might see them in a balanced market pretty soon. Phoenix, Mesa, Scottsdale, Glendale, Gilbert, and Tempe all are technically in a seller's market, although none of those are super strong. So depending on the location of your house throughout the valley, you may be experiencing something different as a seller. Some sellers may be experiencing a lot of showings, maybe more than one offer, and getting under contract fairly quickly. And other sellers may be on the market for a longer period of time with a good number of showings, but really no feedback that's constructive and no offers. So market conditions are varying across the metro area. And depending on where you're at and the condition of your house, it could be completely different from city to city. Now, the contract ratio is pretty interesting to look at this week because I wanted to take this back like just even a month and show you guys the change that we've seen. So contract ratio is comparing the number of homes on the market available for sale as compared to how many are actually under contract. And the higher the number, the hotter the market. This is breaking it down by zip codes. It just auto reset right now to June 8th, and you can see a pretty big difference from where I was just at. There's a lot more orange and yellow in this map from June 8th. If we go to July 20th, you'll see that cooling off. A lot of green, a couple zip codes in blue, which is going to be more of a colder market. We have in this zip code 85253, there's 166 active listings and only 28 are under contract. So that is making that contract ratio pretty low, therefore indicating that it's a cold area of the valley. This is actually a contract ratio of 0 because there are 12 active listings and none are under contract in 85034. A lot of green, and green is indicating this balanced warm market. And then we have a couple hot areas, Chandler, in a couple areas. This used to be a much bigger grouping of Chandler zip codes with a warmer indication. It's a little bit smaller now, but a few places in Chandler, Gilbert, Tullison, kind of the same areas as I've been sharing every week that have some hotter zip codes, and then the majority of the valley just in a warm, balanced market. So home buyers, this is good news for you. A warm, balanced market allows you to negotiate a little bit more, and homes are likely not going under contract as quickly. It gives you a bit more time to think about things and make a decision. And like I said, negotiate a little bit more with an offer. So keep that in mind because there are options for you to find an assumable loan, to find seller financing, to ask for seller concessions for rate buy downs, a 2-1 buy down, all of that good stuff. Check the description. You can search for assumable loans and seller financed options, or set up a discovery call with our team if you just have some questions on how all of this would work and what might be the best in your situation. And homeowners, I'm not forgetting about you. I have a link to an instant home valuation if you want to check that out. You guys, I'll be back next Tuesday with another market update. Thanks for joining.